Hello everyone, good afternoon. I'm Alice from Fastmarkets, and we warmly welcome you to join us in the China Fund Market. And now let's invite our panelists, Mr. Duan from Cargill, Cargill Metals. He's a Seaborne iron ore trade and China strategic marketing. And let's welcome Mr. Duan. And then let's welcome Mr. Zhang, Xinzhi from the Trader of Metallurgy Department from ITG Resources. Welcome. Please join me to welcome Clyde Russell from Thomson Reuters, the Asia Commodity and Energy Columnist. Thank you. And then let's welcome Stone Lin, the Physical Trade Director from Majestic. To begin with our discussion, I would like to invite our panelists to do a short self-introduction first. Maybe let's start with Mr. Duan.
Hello everyone, good afternoon. My name is Duan. I come from Cargill Metals. So I have been with Cargill Metals for 7 years. Before that, I was with a Chinese private steel mill, and I spent 12 years with that steel mill. Thank you.
Yeah, hello everyone. I'm Xinzhi from ITG. As an international platform for our mother company, Xiamen ITG, we dedicated in the supply chain, international-wise. Myself is an iron trader, and it's my great honor to be here and sharing some thoughts of our industry. And thanks, everyone.
Good afternoon. My name is Clyde Russell. I'm the Asia Commodities columnist for Thomson Reuters. I've been covering commodity markets for the last 30 years. What I really do is try to get ahead of where everybody else is. I like to float above the markets. I'm not a participant. I'm the odd man out on this panel. But what I try to do is provide insights into commodity markets. And my career has coincided with the rise of China, and China's, for me, been the gift that keeps on giving. So it's a great honor to be here.
So good afternoon, everyone. So my name is Zhang. So first, thank you, Iris, for inviting me here. So I am from Majestic, which is actually a procurement and trading arm of Zhang. It's a steel mill. We have 2 plants in China. So I'm watching over the physical cargoes, including iron ore and coking coal. Thank you very much.
Thank you all. And we know the China fundamental market is a very fantastic topic, as we know that China remains the largest crude steel producer and the largest iron ore importer. And also we noticed recently, like this year, the downstream steel demand and consumption recovery is facing some challenges, and which also has led to more uncertainties to the iron ore demand and prices, as well as mills' preference for different grades of iron ore. And let's start our discussion and see how the industry experts would comment on recent market dynamics. So maybe the first question, I would like to invite Mr. Zhang from ITG Resources. We are very interested to know what happened and what's new in the China's steel industry in early this year, especially compared to previous years, and how these new patterns or new drivers to impact the overall iron ore market in China. Thank you.
Okay, thank you, Alice. It's like, although we all know that the iron ore price dropped more than 30% from 140 to 95 something level. This Q1 is tough for everyone, for trading houses, including ourselves. For the steel mills, it's really tough. But also, I have to head out for the players in our industry, show respect that I think we handling the changes in a very efficient and positive ways. Because we all know that the strategy of the steel mills to hold that relatively low materials inventory has been a while, 1 or 2 years. So it could be fatal. Things could gone very, very bad, even bad than what it is look like now. So the rebar prices might have dropped to 3,000 levels, but it didn't happen. Even in March, end of March, we seen the best spot profit margin for the steel mills over quite a long time. So I guess steel mills have a better sales penetrations. They have a better predictions on the prices. They control their productions well, and trading houses significantly cut their, spec positions, especially the lean long exposures. So we do it ourselves, and we digested the job, I think, in a pretty efficient way. So we didn't let the situation gone out of control. The negative feedback trend would happen, but it didn't happen in this trend. So back to April now. So it's Q2. I think Q2 is gonna be stable in this range. So the darkest time of the most difficult time has passed in the Q1. Thanks.
Okay, thank you, Mr. Zhang. Yes, we noticed the overall iron prices did decreased continuously in the first quarter, but we also noticed the prices have shown some rebound, like since, as you said, from April. And we are very interested to know the reasons behind that. Like maybe we'll pass this question to Mr. Duan, like what are the main factors behind that significant fluctuation after the first quarter, especially like from April to May, like that?
Thanks for your question. So, generally speaking, personally, I think the drivers in over the past 2 years, even to today, are mixed of both reality and expectations. When I say reality, it means fundamental. When we see expectations, it's positive or negative macro policies. So when we analyze the market, we need to find out the principal contradiction of the market movement. Personally, I think the principal contradiction of Q1, it could be the high steel inventory after CNY, especially the rebar inventory after CNY, versus the delayed steel demand after CNY, because that's below market expectation. I think that's the key for the market movement. You know, after Chinese New Year, though, every year the story will come again. The steel inventory keep building, and the demand sometimes keep in time. But for this year, it really delayed. Not only because of the the winter reasons, seasonality, but also because of some macro issues. For example, we see reported that around 19 provinces have delayed their infrastructure projects, and also the tight cash flow is another issue. Also, we checked with several projects. What is told us is we have project in hand, we have demand in hand, but we don't have enough money. So that all this led to the delayed demand for steel. Yeah, I think that's a key point. Yeah. So and another thing is, you know, since 2 years ago, when a boss of a steel mill said well, the steel industry will experience at least 5 years darkest period. So bosses of Chinese steel mills become quite bearish, especially this year. So even before Chinese New Year, the bosses are even all the market players are talking about, the 2024 would be another 2013 to 2015. And that's why we were seeing after Chinese New Year, all the steel mills keep running with low oil inventory and buying less, by selling seaborne buy from port, adjust the purchase ratios, seaborne and port stocks. Yes, that's another factor, yes. Yes, basically I think that's the various things. So based on this, we saw both steel mills and traders, let's say speculators, stop procurement. So, and by contrast, the traders even started dumping cargoes. I mean, if I'm not wrong, it's by the end of March or by the end of February, I forgot that. At that moment, we can see both flat price and the premium dropped significantly. Yeah. So we can see price even drop to something like 90, 95, 96 level. I mean, SGS level. Yeah. However, after that, so we were seeing some improvement from both fundamental and macro perspectives. From the fundamental perspective, so when we talk to steelmills, we are seeing, yeah, they can sell out their daily production. I mean, for rebar, because when the bosses become bearish, steel mills become very successful to their BF operations. So as part of my the talk to the steel mills, so a lot of steel mills, I mean rebar producers have some of their BF capacity and all the rollers. That means the S&D for rebar already improved a lot. And that's also why we can see in rebar, the daily option can be sold out every day. That's a good, positive signal from the fundamental perspective. From the macro perspective, we can see that the NDRC asked the provinces to accelerate their project under the 1 trillion national tariffs of last year to be restarted by the end of June. I think that's a really positive news to the demand for construction steel. So yeah, I think that's the good signal for speculators to long. Yeah, I think that result in the significant rebound. Yeah, I think that's my question. That's my answer to this question. Thank you.
Thank you, Mr. Duan. Very insightful comments. And as both of you mentioned, iron ore prices fluctuation and the reasons behind that. And we're also interested to know from a perspective of a mill side, like how will they deal with such kind of price fluctuation and what's new in their procurement strategy, like the brand preference, the blending strategy in the blast furnace steel making. And maybe Mr. Lin, can you help answer this?
Yeah, so we, as I just mentioned earlier, we have 2 plants which actually are located close to the ports. So actually it's quite common for steel mills now to maintain a very low inventory. For our inventory normally 5 to 7 days. So we have learned that some steel mills which are located next to the port trading, so they may push to the exchange for 2 days. But not like us, we normally have 5 to 7 days. But because our situation may be different, because for Sinojoy is only producing one single steel, which is HRC. So we would like to maintain the consistency of our blending. So you just mentioned about the blending strategies. Actually, we don't quite change the strategy of blending, so we would like to keep it consistent. So we have like a 70% of our raw material based on term contract from the big 3 miners of like BHP, Rio, and Vale, because we would like to. Because we're only producing HRCs, right? So we want the materials to come in time and inconsistent, not like we keep changing according to the market practice. That would be tough for us to, at least for our production team. So this is one thing. The other thing is like, of course, let us say, we also like to know, what is the question for, sorry?
How will steel mills change their inventory procurement or blending strategy under strong price fluctuation?
For price fluctuation, so actually we, as Mr. Zhang also mentioned, so we also use paper to some hedging purpose, but it's not a lot. Sometimes we just adjust a little bit using the paper to, because we buy a lot of term contracts, so we use paper to do a little bit hedging, meaning the price is good, but we actually also want to be consistent with the market price. So we don't like hedge 100% of the term contract, which is not making sense to us, right? So, and the other thing is like we are producing only HRC, so actually we're trying to control the cost as low as possible. So the other, and also trying to keep the blending consistent, actually help us to bring down the cost as much as possible.
Okay, that's interesting to know that. And also, like as you mentioned, most steel mills will have a strategy to keep a low inventory at their own plant. But we also noticed recently or early this year, the iron ore port stocks, iron ore inventory at major Chinese major Chinese ports has been increased a lot to some year high, and maybe like Mr. Russell would like to add some comments on the inventory level. Yeah.
Yes, I mean, I live in Australia, so I tend to look at the big picture when it comes to the Chinese market rather than what each individual steel mill is doing. And if you look at the big picture for perhaps the latter part of last year and the first quarter of this year, what did you actually see? You saw iron ore portside inventories in China at an 8-year low in October, around just above 100 million tons. And by April, those were up at 144 million tons. So you've basically seen 40 million tons come into inventories in that first quarter. The question that you always got to ask yourself is, why were the inventories at an 8-year low in October? It's because the price was high. So people didn't want to buy. So, I mean, this is logical. You know, when the prices go up, people will try and minimize the amount that they buy. You've seen this very much in the crude oil market in China of late. They don't talk about inventories, they don't disclose inventory levels, there's no transparency in it whatsoever, but there are ways of calculating how much crude oil China is putting into storage tanks as opposed to processing. And basically, what they've been doing is when the price of oil goes up, when the OPEC Plus and other producers tighten the market by restricting supply, with a lag of 3 months, which is about how long it takes from buying a cargo to have it physically delivered in the oil market, then you start to see Chinese oil imports moderate. And it's not a huge amount. It goes from maybe 11.5 million barrels a day down to 10.5 million barrels a day. But that extra million barrels a day, which is like 1% of global consumption, is enough to loosen the market just a little bit, that it stymies OPEC Plus's plans to keep oil at $90 a barrel, and it struggles to stay above 80. So what the Chinese oil market has been doing, what they've been doing, is effectively using inventories, putting stuff into storage tanks and then drawing it back out, and they just don't talk about it. I think what you're starting to see in iron ore is perhaps the same sort of dynamic. And it might not be a conscious decision. It might not be the mills and the traders sitting thinking, we're going to build up inventories. It could actually just be how it's turning out from a macro perspective. So the price last year was high. Inventories fell to an 8-year low. The price fell. It dropped down just below $100 at one point in the first quarter. And now you've actually starting to see, you know, those inventories rise. Now, I know there's a seasonality pattern in inventories in the Chinese market, but what you've actually seen is outsized movements within that seasonal pattern. So what you're starting to see is a kind of situation where, from a big picture perspective, Chinese iron ore demands from the seaborne market is probably going to be a fairly steady picture. Might be up or down a little bit, but for the next 5 years, if you're looking for that medium-term thing, you're expecting to see more or less steady volumes. This is because it's quite clear that China wants to cap steel output at no more than 1 billion tons. It might go down a little bit, it might go over a little bit, but you're sort of looking at a steady picture for the foreseeable future, which suggests a steady volume of iron ore imports. So if you were wanting to pay the least amount of money for your iron ore, but you're no longer, you know, sort of driving the market from a demand perspective, it becomes a supply-driven market. So it makes sense for you to buy when supply is sufficient and prices drop, and then when prices rise, dip into those stockpiles. And I don't necessarily think this is all a conscious decision or a trading strategy. It's just how the market will develop. So if you're looking at a kind of flat demand market with little bits of variation, then supply becomes what drives it. And that's how I expect this market to develop. China is becoming, it always used to be for the last 20 years that basically you built it, China would buy it. And certainly that's how, you know, Australian miners worked. And, you know, China had little option. It needed the material. It bought whatever you could produce, be it iron ore, be it copper, be it oil, be it LNG, be it coal. It didn't really matter the commodity. If it was available, China would buy it. Those days are over. China's probably at peak oil. It's probably at peak iron ore. It's probably at peak coal. LNG, maybe it's got a little bit more room to expand in that. But for a lot of commodities, we're actually kind of reaching that peak. And I think that's what you're more going to see now is what I would call China becoming a more price-sensitive buyer. And they'll use tools like inventories in order to manage that prices as much as they possibly can. So I think we're at one of those inflection points. China's still going to be the big consumer of commodities, but it's no longer going to really be the demand driver that drives the entire pricing structure. There'll be other factors more at play. And I think that's starting to become evident in the iron ore market too.
Okay, thank you, Mr. Russ. That's very interesting to talk about the inventory from another perspective. And as Mr. Lin from Majestic Rock just mentioned, like currently mill's strategy is to control the blading cost as low as possible in the short term. But during the morning session and the early afternoon session, there are also talks about like the demand, the future, the long-term demand for higher grade or green iron ore in the future under the global decarbonization. And as we know, China's dual carbon targets for the 2030 and the 2060. And I want to ask from a perspective of a mill side, how do you see the opportunities and the challenges under the decarbonization drive for iron ore procurement strategy?
Well, it's a good question, right? So as a steel mill, we're also concerned about sustainability and also social responsibility, right? So nowadays people are talking about ESG, talking about green steel. Now this forum used to call iron ore forum, now it's called green steel forum, right? So decarbonization is something actually we are working on, and we have already set up a team to look into the process of decarbonization, to try to be in line with the company's, with the government's strategy as well. So of course there is challenges and also there is opportunity. Right? We already see some kind of pilot projects going on, like green steel using hydrogen, ammonia, right? So, but the thing right now, the cost of hydrogen is high, and well, we are producing the same products, right? So I think the cost is one of the main challenges of green steel. And this pilot project, we are still working over that. We haven't taken any steps into that, but we have already invested a lot on like environmentally control. We try to reduce the emission, try to protect the air, try to reduce air pollution as much as possible. Maybe like 5 years ago, when you go to Beijing and go to Thomson, right, you see the air was heavily polluted. People are talking about haze, talking about the kind of bad air smell. But now we step into Thomson. I was in our steel mill last year, and we actually we know the blue sky and the air actually was not that bad anymore. So we have put a lot of effort and we have invested a lot on the environmental control of that. And on top of that, we also, as just mentioned, we also set up a team to see how are we going to decarbonize our products as well, because we are also considering export products to other places. And now we know that EU have already introduced carbon tax, right? So if we can do something to decarbonize our products, like we reduce the carbon footprint, right? So probably maybe advantage for us as well, right? So, but the other thing just I mentioned about these, the main challenges is about the cost. So when you put the the investment, the new project and new plant maybe using hydrogen, then this cost, how are you going to bear for the cost? Because we really know in the past 2 years, not all the steel mills in China are making money. Unlike steel mills in Japan, or maybe I was told by a steel mill from India, they're making huge margin, like $100 per tonnage in India. Like China, $100 per ton is unimaginable right now because they are actually suffering a negative margin, right? So if you see my steel report on the steel margins in the first quarter, always negative. Just starting from the end of March when the price dropped down, you see positive margins of steel. But before that, steel mills are suffering while the price was down, right? I think Mr. Zhang should be quite familiar with that as well. So on top of that, you're also talking about the decarbonization. Probably there is another new opportunities for higher grade iron ore, right? Probably because higher quality iron ore, of course, will reduce certain carbon emission, right? So that may be good for producers. They are producing higher iron ore, higher grade iron ore. But as a steel mill, right? So we are concerned about that, and we we are working close on it as well.
Okay, sure. Thank you, Mr. Lin. That's new to know that. And as you mentioned, steel margin level, yes, we noticed there are still some negative margin levels, and it's also, we heard it's highly relevant to the downstream steel demand recovery, especially from China's property market. Maybe this question, and Mr. Zhang from ITG Resources, how do you think China's property market is impacting the iron ore demand outlook, and especially steel margin level?
Okay, thank you. I mean, first of all, this question is supposed to be very straightforward. But I think a more accurate answer to this is I think our industry has a very good readings on the dynamic of the property market right now in China. Because if we talk about it, oversupplied, yes. Poor residents' income expectations, yes. Will the government give up on the property market? Hell no, and a big no, right? So because we all understand, it's very clear that it has been proved that property market is very, very important. It's so important in Chinese market economy. So with those understandings, I believe everything happens in the property market, no matter if the fundamental-wise or the politic-wise, it's going to be pricing soon. You're going to find the equivalent in a very short period of time. So when we talk about the influence of this variable, it should be have less influence compared with something like exporting or manufacturing. I think it's kind of find it's stable soon, in a very short period of time. So I think the influence of this variable is actually limited recently. That's about it.
Okay, thank you, Mr. Zhang. And the property market did play a very important role in China's steel consumption, but we also noticed some other factors like the infrastructure factor, export factor, and the manufacturing factor in China is developing and have some consumption offset some demand weakness from the property market. So maybe Mr. Duan, can you you mentioned there are a lot of infrastructure projects on hand, but there's very tight cash on hand to bring this project to actual steel demand. Yeah, how do you see that in the short term?
Yes, as you know, both the steel demand, the steel consumption for both property market and the infrastructure would takes around 50% of the steel output in China market. So these two engines plays really important to China's economy. Once these two engines stop running, that will be disaster, not only to the GDP growth, but also to the number of people's employment in China. So I believe the China government will manage this very well. So just like Xinzhi mentioned, so yeah, this impact, we can understand this from a positive perspective. So, as you can see recently, China government already lifted a lot of local restrictive sales policy, like what happened in Beijing, Shenzhen, Guangzhou, Shanghai. Yeah. So personally, I think these positive signals would at least can hold the market. What I mean is the steel demand would be improved, at least cannot go worse in short term. Yeah, that's my personal view. Yes.
Thank you. And as mentioned, export market is also increasing, especially last year. China has exported more than 90 million tons of finished steel products, and which has a significant year-on-year increase. On the country's manufacturing sector is also faster developing. And we have also a question about that, maybe Mr. Lin, can you help answer that? How do you see the steel exports and manufacturing drive the country's demand for steel in the coming year?
It's a quick question. So let us say, take the example for our steel mill, right? So actually, we don't export quite a lot. So let us say, most of our products actually, as I mentioned, is HRC, and actually 95% of our products actually goes into domestic market. Only have less than 5% actually exported to other places. We export it to Southeast Asia, to Middle East, and also to North Africa. We didn't export anything to EU in the last year. So one thing concerned about that, there is heavy tax, heavy duties from EU and from the US as well. So, well, on top of the duties, our price actually is not as competitive as their own products. So that's why I mentioned earlier, we're trying to see what we can do to try to introduce to adopt the decarbonization technologies to help us introduce our products to the EU. So as I just mentioned, our product right now mainly is for domestic market and it's only for manufacturing. Because HRC is for manufacturing, 90% actually goes to manufacturing. So the decline in the real estate, the properties, usually more for construction products like lawn products, rebar, etc. So luckily we don't produce this kind of products, but we also seeing demand from manufacturing and also see other steel mills changing their formula to switch from rebar to HRC as well. That's why now we see the prices of HRC also is dropping because now we see more and more players coming to these markets right now. So you just mentioned about what's the opportunities to export. We do look into to export our products to other countries, but even in Southeast Asia, we also see steel mills booming up. Steel mills from Indonesia, from Malaysia, also from Vietnam itself, from Thailand too. So we also find competition is quite intense. So China is already saturated, so it's tough for us to sell all our products in China. You just mentioned that like in last year, 2023, there was about 90 million exported to other places. I read the data actually is the biggest volume since 2016, right? So we truly believe the volume will increase more this year because of the Chinese domestic market. Mr. Thomson mentioned because now Chinese economy is slowing down, which is quite obvious, right? So demand actually is already quite full. So the only way out is to go abroad to export to other places. But we are also facing the anti-dumping, anti-subsidies tax as well. So the previous panelists they mentioned about the demand from India. This is a market actually we are quite interested to explore. The economy of India is booming and construction is going up. We see a lot of infrastructure construction in India, which is quite a good thing, like quite similar to China like 15 to 20 years ago when the economy was booming. So this may be a good opportunity for steel mills from China to go to explore other markets, but also probably face some kind of control, like anti-dumping tax again from other places as well. So there's a lot of things for us to consider before we go into other markets.
Okay, thank you, Mr. Lin. And Mr. Russell, would you like to add some color on this China's downstream steel demand and their impact on the iron ore price in the short or long term?
I think it's kind of interesting. I mean, we have seen, as you said, there was a very big rise in exports last year, and they've been so far quite strong, steel exports this year. That gets me sort of thinking is, what is the potential? How much higher can they go?
Yes.
And you sort of think, well, as it's been mentioned, the idea that there's all sorts of regulatory barriers to Chinese steel exports increasing into certain markets. Now, there's opportunity in markets that don't have that. I mean, there's a lot of countries without steel industries that are actually quite happy to get reasonably priced steel from China.
Yes.
So they're okay with that. But are you talking, can we see 120 million tons of exports, 150 million tons? And that's where I start to get a little bit skeptical. So I think the idea that there's a much upside available on exports, I think, is not there. I think if you want to see Chinese steel production stay at 1 billion tons this year, it's really going to have to be on the back of a stronger second half for domestic demand, rather than export-led. And the question is, are we actually going to get that stronger second half? Well, a lot of the indicators are quite positive. Manufacturing seems to be recovering. The PMIs certainly indicate that. You're getting more export demand for manufactured goods and products, cars in particular. Where I live, every second electric car I see is now a Chinese-made one. So, it's definitely, the demand is definitely there. So I think you probably see, if there's anything that's going to drive the market, it will be a recovery in domestic demand in the second half. What I look at is, everybody talks about property construction, and it is a big chunk, 35% roughly, but that ignores the 65% of everything else. And that 65% has actually been pretty good. And you've seen it with the public investment. The Chinese government is basically funding a lot of development and property building itself. So I think there's the chance of a stronger second half for steel demand in China is actually quite reasonable. I'm not pessimistic. I think you probably, if anything, that's likely to eat into exports, because if the domestic demand is there will be less opportunity to export or less need to export. So that's where I kind of see the market going at the moment, but I don't see a huge growth in it. So what I really expect is the iron ore price will be short-term driven by news headlines, like it traditionally is. You get a couple of positive numbers, somebody comes out and says something great about, stimulus spending, and boom, the iron ore price goes up. Then you get a couple of bad numbers, and, the Chinese authorities try to talk the market down, as they do every now and again when the price rises too quickly or too high, and then the price will go down. So, but the overall trend is probably towards a kind of flat iron ore price, pretty much because demand is pretty flat. So, once you get through the restocking and the inventories, it really just becomes, meeting the existing demand. And if your starting point is steel production cannot go above 1 billion tons or much above it, it can only be 1 billion or less, then that's not a bullish iron ore picture, is it? The only opportunity then to increase demand comes from building inventories, but there's a limit to that too. So overall, if you sort of say we're going to have a good second half, that probably just takes us to the 1 billion tons of steel, which just means iron ore should be more or less steady.
Yeah, that's right. And there are still more uncertainties for the demand side to support or to impact the iron ore prices for the second half. And also this comes to our the last question, which is also quite interesting, because the previous panelists also discussed how do you see or how do you comment the main driver or downside risk for the iron ore prices in the second half? If some of you may consider the demand, as Mr. Russell said, the demand might be flat, but there are also other factors might impact the prices movement. Yeah, maybe we can start.
Right, it's a quite tricky question, right? So yeah, from a steel mills perspective, we are always bearish because we are losing money. So we would like the price to be as low as possible, which is actually unrealistic, right? So
right.
Yeah, so all these prices is based on supply and demand. So as long as China keeps producing steel, there's always demand for iron ore, and you just keep the iron price frustrating. So I cannot say, how high the price is going to be up or how down it's going to be, but I think it could be consistent frustrating, continue frustrating up or down. So between 100 to maybe 130, something like that. So even with the lower price, we keep producing. Even with the higher price, we still keep producing. That's the strategy we're using now.
Okay, thank you. And
as for the drivers, I think that mainly comes from the steel sector. The first one is a significant production cut. We have experienced several times over the past 3 or 4 years. So whenever there's a significant production cut policy come out from the government, so we can see a sharp drop. Yeah, we don't know what would happen this year, but at least we heard some of that rumor, right? And the other one could be steel demand. Personally, as just we discussed, domestic demand should be okay, but the challenge could come from non-China. So probably I believe everybody already heard about the news. Some non-China government already talk about anti-dumping to China's product, like steel, like cars, right? So all these related to steel production and iron ore further. Yeah. So that could be another uncertainty. And as for the positive one, I think we also should look for could be the stimulus policy from China government. For example, the old for new policy we just heard from the central CCTV, right? And also the positive the property sales policy. So let's see what would happen after maybe in 1 or 2 months time, right? So and then I see from I think our industry also impacted by the US relationship. So once this river improved, and also once we see their bank rate cut, so that's all positive signals to impact our industry. So it's hard to predict how the market goes, but at least we need to pay attention to these kind of drivers. Thank you.
Thank you, thank you. And Mr. Zhang, are you available to answer this question?
Yeah, I think Duan and Yankai have already covered most of the reasons. I would like to add some more because we know that US dollars keep being very, very strong recently. I mean, at least for the Q1 and the first half of the year, you expect to be strong. So I think the capacity, or we say the steel production outside of China has been under pressure for a while. So this variable going to change or keeps the same way for the second half of the year, we don't know. And if you ask me for any expectations, I would say this one is really dangerous and it's a risk. Once the Chinese exporting being affected, then the steel price is gonna react very quick in a very short period of time, and it will definitely influence everything, the structures, because it's in a very, very weak equilibrium right now. So everything just changed that. It could be very fundamental. That's my concern.
Thank you, very insightful. And Mr. Russell, would you like to add some color on that?
Yeah, the way I tend to look at a lot of commodity markets, virtually every commodity market that's traded, is I'll do it from a buyer's perspective, since this is a China panel. What's the point of joy and what's the point of pain? So if you're looking at the iron ore price, the point of joy is anything below $100. I think the steel mills would be delighted with that. That's a joyful price for them. What is the price of pain? Probably, realistically, 130 and above, but certainly above 140, they're going to really be hurting and they're not going to be making any money. You're saying you're not making any money now, so we're already, from your individual perspective, we're already at that point of pain. Now the point is, with commodity markets, the point of joy can only persist if supply is overwhelming. That's not the case in iron ore at the moment. Supply and demand are roughly balanced. So you're not going to get to the point of joy that easily. The point of pain can only persist if there's a lot of demand and you have to buy it. But that's not the case either. So I think we're probably going to be somewhere between those 2 points and then sort of oscillate around them. The other thing I would always say is these are the pain and joy points are not fixed. They do shift around according to market dynamics and other things that influence them. But if you ask me right now, where that midpoint is, I would say between $110 and $120 is the point of comfort, even if it's slightly uncomfortable for some. The point where nobody is happy is actually where the market is best. And where is nobody happy, it's probably around that 110. The producers, iron ore producers, think it should be worth more. The steel mills think it should be worth less. So that's where I would expect the prices to pivot around for the rest of the year, assuming, and it's a big assumption, that Chinese steel production is capped and stays close to 1 billion tons.
Thank you. It seems like 110 is like a tricky point, balance point. And we still have some time, and let's see if there is any question from our slider. Okay, seems so maybe I will pause here, and if we have more questions, we can discuss with our industry experts during the expert, and I will appreciate if you can join me with applause to say thank you all of our panelists. Thank you.